Hello everyone, welcome back to this week's Technical Insights. The US equity markets ended mixed last Friday as investors await the FOMC policy decision that is due this week. The Dow Jones Industrial Average fell 0.2% or 86 points for a 7th straight session on Friday to end at 43,828 points, while the tech-heavy Nasdaq Composite Index rose 0.12% or 23 points to 19,926 points. The technology stocks continued to lead the overall market last week as compared to the other sectors. The S&P 500 was almost unchanged on Friday, dropping less than a point to close at 6,051 points. For the week, the Dow Jones Index declined 1.82%, while the S&P 500 slipped about 0.64%, ending a 3-week winning streak. The Nasdaq Composite Index, meanwhile, rose 0.34% for the week for a 4th consecutive winning week. Last Wednesday, official US data release showed that the monthly consumer inflation accelerated in line with market estimation in November. And on Thursday, the producer prices rose more than expected, causing much volatility in the market. The probability that the US Central Bank or the FOMC meeting will cut the interest rate by 25 basis points this week reached 93% on Friday, up from an 86% reading a week earlier. The hotter than expected reading on the producer price index underscored the need for a patient approach to 2025 monetary policy. Broadcom shares was the top gainer on the S&P 500 and the Nasdaq last Friday, surging more than 24%. The chipmaker actually logged stronger than expected fiscal fourth quarter earnings, but its revenue fell short of Wall Street expectation. Broadcom is expected to see strong growth over the next 3 years amid surging AI opportunities and also the addition of new major customers. But Nvidia, on the other hand, fell more than 2%, and Facebook Meta platform shed more than 1%. In Asia, Hong Kong stocks declined on Friday after reports from China Central Economic Work Conference again contained little information about Beijing's stimulus program. The Hang Seng Index retreated 2.09% or 425 points to close at 19,971 points. This is the biggest decline in a month. The Hang Seng Tech Index also fell 2.63% or 121 points to end the week at 4,479 points. Top officials at the key meeting merely echoed the Politburo recent statement promising looser monetary policy, increased deficit spending, and stabilizing housing prices in 2025. That left many investors wanting as the meeting failed again to provide concrete information on specific stimulus measures that the government plans to implement to revitalize growth next year. The scarce stimulus details caused the Chinese property markets to tumble again, and the sell-off expected to Hong Kong tech stock as well, and Meituan fell nearly 4%, while Alibaba also dropped 3% last Friday. For the week, the HSI managed to close slightly up 0.53%, and the Hang Seng Index also managed to eke out a very small gain of 0.33%. Back in Singapore, our STI index actually advanced about 1 point or 0.03% to close at 3,810 points on Friday. For the week, we managed to eke out a very small gain of 0.37% for the second consecutive winning week after last week's 1.52% gain. The Singapore benchmark index traded in a very narrow range of 35 points last week between the 3,820 points high and on the lower side at 3,785 points. The biggest gainer on the STI last week included Yangzijiang Shipbuilding, who was up 7.1%, and Singtel was up 3.6%, with OCBC rounding up the top three at 2.2% gain. Singtel repurchased 2.7 million shares at an average price of $3.07 each last Wednesday, totaling Sing$ 8.3 million, according to a same-day filing on the Singapore Exchange. The share buyback was part of the Singtel Performance share plan, bringing the total shares repurchased to 9.8 million, or about 0.06% of its issued shares since the program began in July. So for this week's technical analysis, let's look at telco giant again, Singtel. Last Friday, Singtel shares rose by 6 cents or 1.95% to end at $3.14. For the week, the share price was up more than 3.6%. The previous time we covered Singtel was on the 2nd of December video, somewhere over here. You can click on the link around this video to rewatch it on our YouTube channel. We noted then that Singtel share price was in a predominant uptrend this year, especially in the second half of 2024. And the support for Singtel share price will likely come around the $3 level, with the Bollinger Band showing support at the 2.99 level as well. On the 6th of December, that same week, Singtel share price dropped to a low of $3.01 over here, barely missing the support level that we identified at the $3 level. Singtel share price then rebounded to last Friday high of $3.15. Looking at the indicators now, the MACD is now showing a positive reading, indicating that the MACD line has crossed above the signal line, a confirmation of the resumption in the uptrend. The latest RSI reading at 53 points have also crossed above the 50-point neutral mark from the 43 points level on the 2nd of December. This shows that Singtel share price is starting to gain uptrend momentum again as well. With both the MACD indicator confirming an uptrend and the RSI signaling that Singtel share price is gaining uptrend momentum, the next resistance to watch out for will be the upper bound of the Bollinger Band at $3.20. With the next high at the 8th of November high of $3.26, the next resistance to watch out for. For support level, the 20 days moving average, which is the white line in the middle, now at $3.09, will become the first support level, with the low bound of the Bollinger Band still at $2.99, landing further support at the sub $3 level. Based on 17 analysts covering Singtel in the past 3 months, 64.5% have a strong buy call, and 35.5% also have a buy call on Singtel share price. There is no hold call or no sell call. The average target price for Singtel among the analysts is $3.72, with a maximum estimate of $4.60 and a minimum estimate of $3.37. And these are the updates that I have for you this week. I hope you find the information useful, so do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you again next week in the next Technical Insights.